Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Crocs because on a recent video there was a comment that said I would buy Crocs over Birkenstock. So I figured let's take a look at it and see how the two compare. And both of them look pretty good. So as a reminder, Birkenstock, I came up with a fair value around 46. So at the moment, it's about 5% undervalued, or with annual returns of 13.5%. And for Crocs, I'm coming up with a fair value of 145. Currently, it's 125, so it is around 15% undervalued. But the average returns are coming up about 7.5%. So clearly, Birkenstock is more of a growth stock, and Crocs is more of a value stock here. So as we look into things, earnings yield looks good. Double digits, what we like to see. 6.27 would be a good EPS for what it's currently trading for. And when we look at the actual numbers, we see that they are beating that out pretty well. 10.97 last year, 12.44 this next year, and 13.54 the following year, at least according to analysts. Cash flow, great here. 20.5% this last year, usually around that 20% mark. Very good cash flows. Makes a good investment. ROE looks really good. Debt looks pretty dang high, a 2.2. Debt to equity ratio, we like to see that under 1. So that is going to skew this a little bit. ROI looks good. This is probably one of the better ROIs that we've seen. 25% and ROA 17%. So all of these look really good. Those look really good. Margins look really good. Around 56% both last year and on average. Net, they were down a little bit. Usually they're around 21.5. They came in at 20%. Growth-wise, looks like they're slowing it down a little bit, but analysts are expecting it to get back to somewhere between 4 and 5 going forward. So we're going to put 4.5 for our thesis. Cash flows are looking very good. If we stick with 4, they'll be able to hold on to their average. Asset growth, they had a huge jump 2 years back, definitely slowed down more recently. So it's kind of hard to say if they pick it back up, something in line of 5%. If not that, then something closer to 0, hopefully not negative. Liabilities, they had a huge jump 2 years ago as well, and they were negative this last year. So they bought back some of their debt or paid off some of their debt. This one, we're going to be able to pull some levers on. So this could change things at least a little bit, where if we assume that it just stays flat, this is what we're going to be looking at. They don't pay a dividend, and their margins, if they grow them at 2% annually, they'll be up to 22% for their net margin in 5 years. Not bad. That might be a little high, honestly, though. So maybe we can cut that back down to 1%, 1.5. Still, we're looking at 3-year returns beating out the markets by 5% and 5-year returns beating out the markets by 3%. Now, the story with the liabilities here, that's probably the biggest lever that we have to pull. If they continue to buy them back, let's just say 5% here, and we get a pretty good jump. Now we're making an extra 1% per year, and you're beating out the market by 8% in the 3-year and 14% in the 5-year. So definitely looking a lot better. And it might be reasonable with those cash flows and what they did this last year. Looks like it could be pretty good. Another lever that we have is share count. They had issued some shares, then they started buying them back. So assuming that they're flat in the original thesis, if they continue buying them back, I feel like 0.5% is pretty fair. There you go. You get another about 0.5% worth of growth there. And now you're looking at beating out the market pretty well in the 3-year, 14%, and in the 5-year, beating it out by 18%. My biggest complaint here is this debt level, and if they can continue paying that down at this rate, things will be improving very quickly. So we can take a quick look at the price charts, see how everything is graphed out. Some nice linear growth here in the balance sheet. You see that's the lowest valuation here. was almost nothing back in 2021 and has been on a very good linear trend since then. The actual share price has been kind of teeter-tottering here. Looks like it's on a bit of a linear trend since 2022, though. It's a pretty solid line that it's got going. Earnings are staying pretty stable in here, valuation-wise. I mean, there's not really any growth. In fact, it looks like it's down in 2024 from what it was in 2020. And then the cash flows are just insane. They've always led, and they don't have quite the same growth as everything else, but they're definitely still growing. So I have no complaints about this stock. Buying it at today's prices, I don't think that you're going to regret it, really. If we can try to find a scenario where you might. Sticking with the analyst projections of 4.5% share count, if they start issuing again, say 1%. Cash flows, if those go negative, I don't think that they would go too negative, but let's test out -3. At that point, you're overperforming in the 3-year, but underperforming in the 5-year. Assets, I don't feel like they would go negative with those. Let's just assume it stays flat. That was a huge drop there. Now you're underperforming by 9% in the 3-year, about half the market returns in the 5-year, and you're only making 2.5% per year. So there are scenarios where it's not going to look as nice for sure. And we can continue it. If they continue growing their liabilities, let's say they grow those at 3%, that's a pretty low fair number. Well, now you're losing. You're losing out year over year in fair value of the stock. And then their margins, they're pretty stable here. If they just hold those flat, you're definitely losing out. 1.7%. You're buying this thing at prices that you'd be looking at being the fair value in 5 years. So this would be an absolute worst case scenario. Almost no growth and some shrinkage in a few metrics, but very unlikely scenario. But this is definitely one that's going to go on the watch list. I think there's some potential here. It's a tough decision between Birkenstocks and Crocs because the earnings yield, cash flow yield, and all of the metrics here look really good. I'd have to see who has a better debt to equity ratio, but Crocs is not bad at all. There's definitely some good potential here. I just think that growth-wise, Birkenstock is going to outperform. So that's what we're looking at for this one. I want to thank you guys for watching. Please like and enjoy the video. Comment if you disagree with anything. I like to see someone said Crocs is better than Birkenstock. We looked at it. It might just be. So I want to hear from you guys and dig into those, see which one really is the better stock. And make sure you subscribe so you can see when I put these videos out what a good fair value and some growth prospects are.